An ethical bank, also known as a social alternative, civic, or sustainable bank, is a bank concerned with the social and environmental impacts of its investments and loans. The ethical banking movement includes ethical investment, impact investment, socially responsible investment, corporate social responsibility, and is also related to such movements as the fair trade movement, ethical consumerism, and social enterprise. Other areas, such as fair trade, have comprehensive codes and regulations to which all industries that wish to be certified as fair trade must adhere. Ethical banking has not developed to this point. Because of this, it is difficult to create a concrete definition distinguishing exactly what it is that sets an ethical bank apart from conventional banks. Ethical banks are regulated by the same authorities as traditional banks and have to abide by the same rules. While there are differences between ethical banks, they share a common set of principles, the most prominent being transparency and social and/or environmental aims of the projects they finance. Ethical banks sometimes work with narrower profit margins than traditional ones, and therefore they may have few offices and operate mostly by phone, internet, or mail. Ethical banking is considered one of several forms of alternative banking. History. The banking system was born in ancient Greece and ancient Rome. Travelers and citizens trusted banks as a means of protection in troubled times. The first two modern banks were opened in Genoa in 1406, Banco San Giorgio, and in Florence, Banco Soranza. Since old-time Christian communities were based on the anti-materialism of Jesus, banking was ethical and any form of usura was considered as immoral. In England, King Offa of Mercia in 791, then King Alfred the Great, as well as King Edward the Confessor, made usurers outlaw. Following the defeat of King Harold II in the Battle of Hastings by King William the Conqueror, a Jews community arrived in England in 1066, from Rouen, France. The role of this community was, in fact, financing the invasion of England. As prize for the help given to the king, they were granted the permission to practice private banking. Due to the very high percentages applied to money and land financing, in 1290 the Jews community was expelled by King Edward I of England. William Cunningham made a clear point describing the practice of usurers as an obstacle to the development of the British Islands since the 11th century. The development of the changes in the banking system due to the influx of Jews in Europe is written by Stephen Goodson in Barnes' Review. One of the most controversial issues in the 21st century is the role played by finance in wars and revolutions in Middle East and North Africa. Noam Chomsky mentioned the US dollar as a source of several changes in societies. Currency substitution and the Islamic banking and finance are among the reasons for the prolonged destabilization of several developing countries. Mainstream financial banks have had varying relationships with corporate social responsibility and ethical investment. However, a clearer movement has emerged since the 1990s, with changing social demands, and as more is known about the effects that banks can have through the lending policies. Banks have begun to feel pressure from the general public, NGOs, governments, regulatory bodies and others to consider the social and environmental impact. Environmentally and socially conscious business practices. In general, all banks play an intermediary role in the economy. Because of this, the possibility for banks to contribute to sustainable development is potentially profound. Jochen 2002. Banks have extensive and efficient credit approval systems, which gives them a comparative advantage in knowledge. Jochen and Amp. Baumer 1999. Banks are well seasoned and well equipped to weigh risks and attach a price to these risks. Because of this, banks can fulfill an important role in reducing the information asymmetry between market parties, for example between the business and consumers. This is important not just to consumers but also to depositors. When depositors allow a bank to invest for them, they are able to assume that the bank will know which investments will maximize the returns. Conventional banks are legally bound to maximize return for the clients. If clients are concerned with more than simple return, then they may need to turn to an ethical bank to find ways in which they can garner return, while keeping to their own moral concerns. Some businesses externalize costs onto the environment and society. An example of this would be water pollution. A wood mill, for example, could dump its waste into a local river instead of paying to dispose of it properly. This cost is then put onto the public who uses this water. The costs could come in the form of poor health or as a cost to the local water treatment plant. In order to create more equitable distribution of costs amongst consumers, the environment, and businesses, banks can raise interest rates or apply tariffs on loans given to clients with high environmental risks. This tariff differentiation by banks will stimulate the internalization of environmental costs in market prices. Jochen and Amp. Baumer 1999, meaning that companies would pay more if the business caused extensive environmental damage, taking some of the cost off, if society as a whole, and putting it on the company. Through such price differentiation, banks have the potential to foster sustainability. Jochen and Amp. Baumer 1999. This potential would be determined by the extent to which all banks worked in unison to create similar regulations that would result in the loss of access loans that treat the environment and/or society as an externality. Through their intermediary role, banks may be able to support progress towards sustainability by society as a whole, for example, by adopting a carrot-and-stick approach, where environmental and social front-runners would pay less interest than the market price for borrowing capital, while environmental laggards would pay a much higher interest rate. Jochen and Amp. Baumer 1999. Banks can also develop more sustainable products, such as environmental, social, or ethical investment funds. In addition, there is great scope for banks to improve their internal environmental performance. Jochen and Amp. Baumer 1999. In creating environmental and social screens, banks can promote socially, environmentally geared companies and penalize those who do not conform to these standards. However, it is important that these different possibilities be used as a package. If not, there is a danger that banks could simply do the things that make them look the most ethical while not changing other areas that would have a larger impact. If the changes are solely driven by customers, the bank will be pressured to offer preferential treatment to what depositors deem as desirable, but will have limited ability to punish undesirable action. Governmental regulation, initiated by an informed and involved public, would be an effective way to ensure that all banks follow socially accepted morals and ethics. Ethical initiatives. Numerous ethical banks allow customers to contribute to organizations that have positive societal, environmental impacts either in the local community or in developing countries. Examples include an evaluation of the energy efficiency of a home and potential improvements in this. Carbon offsets. Coro Strandberg 2005. Credit cards that benefit charities are lower interest rate loans for low-emission cars. Community involvement. Ethical banks excel in community involvement, as do other financial institutions such as credit unions. Community involvement is not limited to ethical banks, as conventional banks also partake in such actions. The following are a few examples of community involvement done by ethical banks, credit unions, and conventional banks. Affordable housing projects. Many banks, credit unions try to increase financial literacy in the community, give local scholarships and AMP sponsorships, financially support community events, Environmental standards for lending. Environment is a key focus amongst ethical banks as well as amongst many conventional banks that wish to appear more ethically oriented and that see switching to more environmental practices to be to their advantage. Some view this move as greenwashing. In general, bankers consider themselves to be in a relatively environmentally friendly industry. However, given the potential exposure to risk, they have been surprisingly slow to examine the environmental performance of the clients. A stated reason for this is that such an examination would require interference with a client's activities. Jochen 2002. While the desire to not meddle in the business of the client is valid, one could also note that banks are required to interfere in the business of the clients regularly to ensure that the client's business plan is viable before issuing them a loan. The kind of analysis that all banks partake in is termed a single bottom line analysis. It is arguable whether or not performing a triple bottom line analysis would be any more intrusive. Judging what is ethical. Claiming to be an ethical bank requires an objective way to determine what is ethical. Popular ethical theories that could be used include those of Mill, Kant and Aristotle. John Stuart Mill. The premises of John Stuart Mill's utilitarian ethical theory is that an action's moral status is dependent on the extent to which it contributes to happiness. Therefore, in Mill's perspective, a bank would be moral if it tended to promote happiness. Mill 1957. If the bank in question acts in a way that produces the greatest amount of happiness for the greatest amount of people, then it will be acting morally. According to Mill, because the banking sector is so large, complex and far-reaching in its effects, it is difficult to accurately judge the happiness of everyone affected by the conduct of banks in general, or by certain banks in particular. However, it's sometimes possible to discern which of different possible courses of action would produce the most happiness. For example, the act of generous philanthropy in forms such as giving back to communities, employees, members, environmental development groups, etc., will on the whole increase happiness. Similarly, lending to businesses that do not produce the reverse of happiness. Mill 1957. By, for example, giving to businesses that treat employees fairly and are concerned with such public goods as the environment would also be considered ethical. According to Mill, given that things such as global warming, air pollution, water contamination, and soil pollution negatively affect large groups of the population, if not all of the population, banks that chose to partake in the above examples could be viewed as contributing to the overall happiness of all people and would hence have moral value. Immanuel Kant. According to Immanuel Kant's categorical imperative, morality concerns intentions and not outcomes. A person is moral insofar as they act with a good will, regardless of the consequences. With this knowledge, one could propose that the act of lending money is not in and of itself immoral, and according to Kant's perspective, banks should not be judged as moral or immoral based on the outcomes of their lending. However, the second formulation of Kant's categorical imperative states, act in such a way that you always treat humanity, whether in your own person or in the person of any other, never simply as a means, but always at the same time as an end. Kant 1956. Based on this formula, one could argue that the whole practice of lending is not ethical, since it treats human persons merely as means to gaining money, rather than as ends in themselves. Aristotle. For Aristotle, lawfulness is important in the measurement of morality, as is equality and justice. Whether an action is or is not in accordance with the law is an important measurement of morality for Aristotle. Many banks do business in accordance with the law in all practices. They may also specifically seek to do business with law-abiding clients. Nevertheless, this can be problematic, as laws vary internationally. This means that a bank could be viewed as ethical even while funding clients who lawfully conduct business in harmful manners. However, this measurement is challenged by Aristotle's statement, "What is just in transactions is something equitable, and what is unjust is something inequitable." Aristotle 2002. This means that a bank needs to take into account the unjust, inequitable behavior of its borrowers to qualify as an ethical bank. For example, lending to a law-abiding corporation that does not pay its employees a sufficient living wage would be immoral. Thoughts from Indian Scriptures. 1. The Purushartha concept. This ethical guideline speaks about the necessity to keep Dharma as the foundation for every choice that is made. Artha stands for generation and sustenance of wealth, including monetary wealth. Karma is related to choices made regarding fulfillment of desires, and moksha is about spiritual fulfillment. Exploration related to artha and karma has to be done within the contexts of dharma and moksha. Moksha is considered the supreme goal. These four are considered to be purushartha. 2. Paropakarathmidam shariram. The body is meant for the service of the noblest ideas and to contribute to the well-being of all. 3. Atmano mokshatham jagatita yacha. The actions one perform in achieving one's liberation, fulfillment has to be done in the context of the well-being of the world. Bank regulations and the free market. The argument against regulating banks is that the regulations would violate the proper functioning of the free market economy. Severin T. Brown disputes this argument in his article, The Moral Economy. Bryan 1999. He states that the extreme disconnection between market actions and morals was never the intent of the market economy's founding thinkers, specifically Adam Smith. He argues that putting standards and regulations in place that rest on the basic morals of society should not conflict with the free market, but are actually an important part of the proper functioning of the free market. His conclusion is based on statements made by Adam Smith. When Smith first envisioned the market economy, he did not divorce morals from the market. In fact, morals were supposed to be a natural part of the workings of the market economy. He believed that economic transactions should be the result of mutual agreement and should involve morality and friendship. He stated that selfishness could obstruct the market economy from running morally. If interpersonal relationships did not play a part, then the interdependency experienced by individuals could vanish and unfair play based on greed and mistrust would exist. Brown discusses today's society as one that has lost its basic morals in the market. He states that there is a need for a reigniting of civil society. Bryan 1999. Originally, civil society was assumed to be naturally able to regulate the morality of the market, but with the great distances between individuals involved in transactions as time has passed, governments became the prime regulators of morality in economic exchanges. In recent history, governments have been pressured to stop interfering in the economy. This has allowed bodies such as corporations, which operate immorally or at best amorally, to create extremely damaging outcomes without legal or societal penalty. Brown promotes the resurrection of civil society, calling society to demand fair practices and to regulate the morality of the economy. Rudolf Steiner suggested that capitalism has the task of funding economic initiatives. Capital should be directed into directions productive for society. He proposed that rather than prices being set through either the total control of government regulation or the total lack of control of a free market, each industry could have self-regulating associations of producers, wholesale and retail businesses, and consumers. These associations would determine prices fair to all three groups. The state would not interfere with purely economic decisions but would be responsible for protecting human rights and equality of its citizens. Rights. differences from credit unions. Credit unions are not banks, but they offer many of the same services as banks. Credit unions are member-owned rather than shareholder-owned. This gives each member more influence in the decision-making process. When a credit union has surplus, the profits made will either be invested into the community or will go back to the members in the form of patronage rebates. Credit unions focus on the members because they are also the owners, and on the communities in which they are situated. Credit unions put a higher focus on local community development than banks do. Most credit unions lend strictly to people and businesses in the community where the union is located. This fact leads credit unions to affect communities more positively than regular banks. However, credit unions do not necessarily have the same potential to cause widespread change in business practices as ethical banks do. This is because credit unions largely avoid the problem of funding unethical corporate business activities by focusing on funding local businesses, which are easier to monitor and arguably less capable of generating wide-reaching social and environmental benefit. List of ethical banks. Europe: Denmark Handelskassen Arbejdens Landsbank, Dragsomsparekasse, Folksparekassen, Merkur Handelskasse, Germany GLS Bank, Ethik Bank, Triodos Bank, Triodos.The, Umweltbank, Spain Colonia Keksapolenka, Keksa Ontinion, Coop 57, Fear, Triodos Bank, Triodos, S, Switzerland Alternative Bank Schweiz ABS, United Kingdom Charity Bank, Org, Ecology Building Society, Islamic Bank of Britain, Reliance Bank, Shared Interest, Triodos Bank, Triodos, Co., UK, Unity Trust Bank, other European countries: Austria Ethik Bank, Belgique Triodos Bank, Triodos, B, France, Credit Cooperative, France, NEF, Hungary, Magnet Bank, Italy, Banca Etica, Netherlands, ASN Bank, Netherlands, Triodos Bank, Triodos, NI, Norway, Kultura Bank, Sweden, Jack Members Bank, Sweden, SV, Echo Banken, Switzerland, Alternative Bank Schweiz, North America, Canada, ATB Financial, based in Edmonton, Alberta, owned by the province of Alberta, Citizens Bank of Canada, based in Vancouver, British Columbia, USA Urban Partnership Bank, based in Chicago, Successor Shore Bank, RSF Social Finance, based in San Francisco, not a bank, but offers social investment accounts with rates comparable to bank CDs. New Resource Bank, based in San Francisco. New Resource is a commercial bank that focuses on businesses that share the mission to progress sustainability within their community. First Green Bank, based in Mount Dora, FL, is a commercial bank dedicated to ethical practices and environmentally friendly investments. One Pacific Coast Bank, based in Oakland, with branches in Seattle, Portland, and Owego. Spring Bank, based in the Bronx, New York, with branches in the Bronx and Manhattan, New York. Spring Bank is an FDIC-insured commercial lender and certified community development financial institution with a stated mission to expanding financial inclusion in low-income neighborhoods. Oceania Australia Bank Matthew, New Zealand Pro Matthew, Alliances and Networks, Global Alliance for Banking on Values. The Global Alliance for Banking on Values is a membership organization founded in March 2009 by BRAC Bank in Bangladesh, GLS Bank in Germany, Shore Bank in the US, and Triodos Bank in the Netherlands. It is currently made up of 27 of the world's leading sustainable banks, from Asia, Africa, Latin America to North America and Europe. National Community Investment Fund, National Community Investment Fund invests in mission-oriented banks and other financial institutions that provide responsible financial services in underserved communities. The NCIF network includes over 30 U.S. banks that qualify for inclusion based on the social performance metrics and on the participation with NCIF initiatives to advance mission-oriented banking.